we originally adopted Basel, it was because of competitiveness concerns with the Japanese banks, right? And we said, well, get them on an even playing level, they'll have to have the same capital level as we do. But then it turns out they have different accounting systems, they have different government subsidies, they have different forms of regulation that have nothing to do with capital. So you have to add all of that into the picture when you're thinking about competitiveness.
Any other reactions on competitiveness? Ryan.
I would just say certainly we have a higher SLR requirement than other jurisdictions, although that does not seem to have stopped our banks from competing very well against a lot of the international banks. I think certainly non-bank financials have significantly increased their scale and scope in some of these businesses, and obviously they don't have the same regulation, so that might have merit.
Yeah. And moderators don't get to vent their own views, but it does seem like better capitalized banks are better able to compete in principle.
Yeah, that was the point I was going to make. I don't think the UK, European, Japanese banks would think that they're at an advantage because their capital hasn't been gold-plated. I think the U.S. banks are pretty much competing very, very well in the international field. And there are times when being well capitalized, having high capital is to your advantage because, of course, under stress, there's much less to worry about. And we saw that in the U.S. in the March 23 situation where deposits fled from regional banks where people were concerned about the embedded losses on treasuries and other things, and they fled to the GSIBs. And some of the commentary, well, that's because the GSIBs are too big to fail. But I think it was also because the GSIBs were much better capitalized and much, much less likely to fail.
Okay.
I'll make one observation, which
yes,
is
go
that
ahead, Ben.
you receive a lot of questions about the regulatory capital or liquidity treatment about particular transactions or products and things of that nature. I think that does clearly illustrate that they're marginal incentives and essentially what the marginal capital cost, liquidity cost does factor in. That's not necessarily contradictory, but I think it does show that that actual marginal effects of regulation do factor into business decisions. And there are differences between U.S. and non-U.S. requirements.
Tiffany, at a global bank.
Well, I was going to re-highlight some of Don's points. One being completely support interest rate risk management. It's a strong pillar. It's an important risk pillar. And as I mentioned, it's an important part of the overall risk management framework for banks. Second, the holistic review, I think, is an important point as well because we find that, again, managing to a lot of risk measures, making a change to one risk measure is likely going to have another become binding over time and could have the same constraints, let's say, on the Treasury market. So I think that holistic review is also makes a lot of sense.
Terrific. Okay, I think we got a pretty good sense of the views of the panel, and I think it's time to turn to you all. If you have a question, would you raise a hand? I see there are microphones. Would you also please identify yourself and try to keep it to a question, just one. If we have a second round, we can come back, and not a speech, just a question, please.
My name is Guowei Zhang. I'm with SIFMA. My question is, as you know, currently Category 1, 2, 3 banks are subject to 2 leverage ratios. One is supplementary leverage ratio, the other one is Tier 1 leverage ratio. And the question is, why do you think 2 ratios, both target leverage, are needed for these banks?
Okay, I'm going to ask anyone that can address that question, because I don't want to handle that one. Hal, do you have a thought on that?
I'm not going to defend one of 2 ratios, and I disagree with both of them.
Okay. I'm watching for hands. Yes.
Hi, Sharon Ishai from Morgan Stanley. I actually have a question directly to Don. You mentioned that you think that we should have a countercyclical buffer. You mentioned overlap between different parts of the capital regime. You mentioned that it was something that made sense in the UK, but at the same time, the US has a much different capital regime, inclusive of the CCAR test, for example, which does give you an ability to build capital to be there for stress. And so I'm curious as to why you would want to impair potential use of capital from the banking institutions in a period of stress where they could be using it to lend and still put on an additional countercyclical buffer on top of that. So it's almost as though the concept behind having overlap is not necessarily taken into account from a buffer mentality where you don't necessarily have the CCAR exam in the UK.
Yeah, so I certainly think there's simplification and the two leverage ratios and overlap between things. That's why this is such a great event today, because the authorities can hear views about how these things interact and whatnot. But I do think my countercyclical buffer thought, or at least the way we exercised it in the UK, was exactly to free up capital in a stress event. And by lowering by taking out the countercyclical part, you enabled banks to use that capital without running into restrictions on dividends and buybacks and that kind of thing. So our view, and I think as I've read the studies that came out of the March 2020 COVID thing, that for countries in Europe that had countercyclical buffers, they found that the ones that released those buffers had better lending experiences than the ones that didn't. So maybe I didn't understand quite your question totally, but the whole point of the countercyclical buffer is to encourage lending in stress situations or discourage having a constriction of credit add to a stress situation.
Alistair. Oh, sorry. Yes, you. Thank you.
Bill Demchak. I'm
Sorry,
the
Bill,
CEO of
pardon me.
PNC. Just an observation. This entire conversation on leverage ratio and then pointing to the functioning of the Treasury market. What we're actually talking about is the ability of prime brokers to increase their balance sheet in times of stress. So the noise around, hey, banks are just going to go buy more themselves up because they can take more interest rate. We're not going to buy any more treasuries. We can get duration 100 different ways without going to the Treasury market. We can do it off balance sheet through swaps. What we're simply talking about is it a good idea to give GSIBs the ability to grow their prime brokerage operation to support the actual capital providers into the Treasury market today, which are principally hedge funds. And by the way, I am in favor of that, but I would reduce the conversation to that because I think our issue ultimately becomes the size of prime brokerage across Wall Street as opposed to what the leverage ratio is.
So Bill, would the support for hedge funds and others through prime brokerage increase in a stress? So I think one risk, isn't it, that this actually enables the hedge funds to become more levered. Yes. Because banks, and now you've got a stress hit and the margins start increasing and the pressure on the hedge funds, the basis trade blows up even worse.
You're picking your poison, but that is the correct discussion. So banks, since I worked on a primary dealer desk 30 years ago, they don't take down the auctions anymore, right? We used to, we no longer. The hedge funds bid the auctions, the big banks finance the auctions. If you get an off-the-run treasury that won't trade because it's unfinanceable, you get disruption and dislocation. So you want to be able to finance it. You say, all right, well, I want the treasury market to function because we're running the biggest deficit we ever had and it's likely to grow. So therefore, I need to get capacity to make this thing work. I need to expand primary deal, the prime brokerage, central clearing, a whole bunch of other things to allow that to happen, all of which I'm in favor for. But I'm simply saying that we're consciously choosing to ask banks to finance a larger portion of the principal positions of the players in the treasury markets. That's what this rule is about.
Yes, Pete, a question right here.
I have a follow-up actually to Bill's observation.
Could you give your,
Sure.
your name, Pete?
Peter Blaustein, PB Investment Partners. So a follow-up to Bill's question is perhaps heretical, which is to ask, are there other rules that should be addressed if we're trying to get more Treasury market liquidity, namely proprietary trading in the Volcker rule? Should banks rebuild relative value fixed income desks that all migrated out of the banks post-Dodd-Frank, post-Volcker, and that should be the place for Treasury market intermediation rather than hedge funds as Bill suggests? Just an off-the-run thought. Thank you. I'm curious if any panelists support that view.
Any views, panelists?
Well, I think in the context of looking at and taking a look at regulations overall, it's an important holistic piece of the discussion today. I do think in the context of intermediation is one piece of the Treasury market. Certainly that is a very important activity during a period of stress. But to the point of it's a 30 trillion, close to 30 trillion market today, growing. Intermediaries are one player in that market. Buyers and holders across all different banks is something that we need to and should consider to continue to support that market. So that's the kind of broad view, and looking at broadly regulations overall is, I think certainly the leverage ratio is a step in the right direction, but taking that big picture view as part of that holistic discussion that we're having here today as well.
Yeah. Subjected to market risk capital.
Market risk, interest rate risk management.
Interest rate
Yeah.
risk management, right.
The proposal does cite some research, for example, by Falk Breining and Hilary Stein at the Federal Reserve Bank of Boston, showing that those dealers that were relatively more constrained by SLR provided relatively less liquidity to Treasury markets in the March 2020 event. And more recently, a Federal Reserve Board study by Mary Tian and her co-authors showed that those banks that have more headroom under the supplementary leverage ratio provided more financing, to Bill's point, in the Treasury market. So there is some research in support of what you're all saying. Other?
Daryl?
Yes, Hal?
So I understood the question basically was, let's get rid of the Volcker rule so we can have more prop trading that could actually help the Treasury market. It's the implication. Okay. Okay. So, I understood why we did have the Volcker rule. It was kind of a populist measure back at the time when Scott Brown got elected in Massachusetts. So I remember the Senate hearing on this and the Democrats being puzzled about why we were even doing this. If prop trading would help the Treasury market, I would be in favor of re-examining the Volcker rule. But I want to caution everyone as we talk about all these changes, there is legislation to consider here. This is not something that the Fed or other regulators can easily do on their own. A lot of these changes are embedded in statutes, okay? Now, maybe the president can be creative with executive orders in this area, but as we proceed on this line, we have to ask ourselves, how much can the regulators do without legislative change? And that's a big constraint, okay, in this picture.
Just to be clear, in the legislation, the Treasury market is exempted from the Volcker rule, so it doesn't really restrict proprietary trading in the Treasury market. So let's have another question.
Daryl.
That's not true? Treasury securities are not exempted from the Volcker rule? I think they are. Al?
Daryl. All right.
Sorry.
Norbert Michel, Cato. Hi.
Yeah.
Sort of an efficiency question along those same lines. If we're worried about specific activities, okay, and if we're worried about source of strength actually being source of strength at the holding company level, why aren't we more worried about the capital at the IDI level as opposed to holding company level?
So let's revisit that. Anyone have a reaction on this issue of capital at the insured depository versus the holding company? Ben, you have your light
Yeah,
on.
I think capital at the insured depository institution level is a relevant consideration, but we're looking at it today from a level that's high based on a leverage requirement that's also uniquely applicable at the GSIB IDI level, which is just not aligned with the general framework that we currently have. And so it is important to balance what's at the holding company, what's at the bank. And as I was expressing earlier, I think this rule would strike a better balance, but that doesn't mean that going lower is forever going to be a better thing. It's that it's necessary to balance all these things. So it's that this rule strikes a better relationship with the broader framework, in my view.
Okay, I'm watching for hands. I'm also watching the time. We have a couple more minutes. Yes, now Al.
Sure. Thank you. Al Moffat, JP Morgan Chase. So there's been a lot of discussion just early about the role of the leverage ratios as it relates to the Treasury market. And one thing I haven't heard from the panel is the effect on deposits. And so one of the things we saw during the periods of QE was that there was significant growth in deposits prior to the Fed rolling out the overnight RRP program. And strikes me that the changes to the leverage ratio may, reshape that into a potential next crisis. And I'm just wondering if the panel has any thoughts on the role of, particularly the value of changing the SLR for the IDI and the consequence on deposits and other low-risk activities like that, even if they are put into cash and not 30-year Treasury bonds. Just, maybe that potentially offers flexibility for the Federal Reserve in the size of the RRP program. But welcome any thoughts.
Who has a thought about this? Ben.
I was going to say the economic analysis of the proposal makes very clear that just in the past years and probably over longer periods, the degree of low-risk assets, treasuries, reserve bank deposits are much higher now than they've been in historical past. And I think that's important for the ESLR. It's also important for the basic Tier 1 leverage ratio. They have 4%, 5% structure in the prompt corrective action framework. It's been around for a very long time. When it first was implemented, I would be very confident that reserve bank balances and treasuries were a much smaller portion of bank balance sheets. Thinking about the overall structure of the capital framework, looking at the evolution of bank balance sheets, the degree of low-risk activities that are related to deposit taking, liquidity risk management, I think it's a very important consideration.
Tiffany.
I agree. As you mentioned, Al, heightened cash balances, heightened deposits, particularly in a period of stress, it typically coincides with when also Treasury intermediation is important. But ensuring, which is why we talk about a targeted approach that specifically excludes cash, for example, because banks tend to be that shock absorber of cash and deposits, whether it be in the immediate stress or afterwards as a result of monetary or fiscal policy. And banks having the ability to support that in periods, particularly volatility or stress, is important. And I agree that both supplemental leverage ratio as well as the Tier 1 leverage ratio should also focus on that.
Yes, and I think just to reinforce that, making sure the leverage ratio doesn't impede the banking system when the Fed is doing QE and adding to those deposits that you were talking about. And that's at the Bank of England. We exempted deposits at the Bank of England when we wanted to make sure that was. So I think, as I said, I would be opposed to exempting Treasuries blanket, but I think thinking about exempting deposits at the Federal Reserve from the denominator, along with the other things, is worth consideration.
And that's a good point in that the PRA has made that exclusion as well in their leverage ratios, specifically for cash.
If I could, I just have a quick add-on that ought to be part of this discussion, and that's FDIC insurance on size of your balance sheet. They're the only measure still left where you go period end. And so one of the reasons you see repo get very tight at the end of a month is simply because everybody's calculating their balance sheet on period end. If they averaged it, you'd likely get rid of the month-end crunches. It seems to be a pretty easy fix.
Good to know. Okay, so we've run our allotted time. I just want to thank the panel for an extremely illuminating discussion. Lots of back and forth, good audience participation. I learned a lot. And I want to thank Vice Chair Bowman again for inviting us to speak here today. Thank you.
All right, we'll get started in about 30 seconds. So if you haven't taken your seat already, I ask that you please do so.
Good morning. My name is Jonathan Gould. I'm the 32nd Comptroller of the Currency. Although I was sworn in less than a week ago, it's great to be here. And I look forward to engaging on these very important issues going forward. I greatly appreciate the range of perspectives and views that are being presented here today. And I thank the Vice Chairman for Supervision for her efforts in this area and her invitation to attend today's event. One of my areas of focus as Comptroller is ensuring regulation and supervision are properly calibrated and appropriately focused on safety and soundness. To that end, I believe it is prudent to consider the appropriate risk tolerances and capital requirements that are required for the largest banks, and how these choices may impact other banks as well. This next panel is focused on the evolution of the capital framework, including what has come to be known as Basel III. This distinguished panel will share their thoughts on several topics of interest, including the global framework, tailoring, interactions with other prudential requirements such as stress tests, and the impacts on economic growth and financial stability. I'd like to thank our distinguished panelists for appearing today and would like to turn the discussion over to panel moderator, the inimitable Rob Blackwell. Thank you.
Thank you very much. Thank you very much, and thank you to Fed Vice Chair Bowman for having this conference. This is very exciting. I have a wonderful panel in front of us. I am not going to do justice to any of their biographies. That way we can get straight to the questions and presentation. But so that we'll give you a brief overview. Phil Evans, to my left, is Director of Prudential Policy at the Bank of England. As part of that role, he's in charge of implementing Basel Endgame in the UK, called Basel 3.1 there. He previously was in charge of coordinating the bank's work on the UK's withdrawal from the European Union. Shira Friedman is the Chief Accounting Officer and Controller for Goldman Sachs. As such, she is responsible for the oversight of external and internal reporting, product control, and regulatory capital. Randall Quarles is the Chairman and Co-founder of the Synosia Group, a Utah-based investment firm. He was the first person to serve as Vice Chair of Banking Supervision at the Fed, serving that role for 4 years between 2017 and 2021. Last and not least is Mike Mayo. He's Managing Director and Head of the U.S. Large Cap Bank Research at Wells Fargo Securities. He is the first analyst to testify on the causes of the great financial crisis, and he is representing himself, not the views of the bank. So I'm going to actually kick off right. I just want to make that clear from the outset. I'm going to kick it off, and you'll see why in a second. I'm going to kick it off directly to Mike, who's going to give us an overview, a brief overview, but very entertaining overview of how we got here. When we talk about Basel Endgame, what are we looking at, and how did we end up in this place?
Well, Rob, thank you, and thank you to the board.
The mic button. Sorry. Mic to the mic. Yeah, it's the button with the voice.
Oh, it's the big with the mouth.
Yep.
Okay, there we go. Look what I found in the hallway as I came. Look, I love the idea of a regulatory reset. Let's keep banks safe and sound, but rip out as much bureaucracy and red tape as possible. And so I'd start with, first, thank you, regulators, for what you did after the global financial crisis. You made the system so much more strong than elsewhere around the world, and I'll spend 2.5 minutes on these. But the system today, it's too confusing, too constraining, and too costly. And when I worked here in this building 35 years ago, the capital rules were simple and weak, and today they are complex and strong, so let's make them simpler and strong. And I did a proprietary survey to institutional investors. Those are the largest pension, hedge funds, mutual funds around. And 9 out of 10 investors, these are the owners of the banks, find the capital rules confusing. There's too much regulatory risk. Regulatory risk wasn't even a phrase a few decades ago. There's other risks you have to contend with, not the 4 words that strike at the heart of investors. What will regulators do? There's too many targets, it's acronym soup, and too much capital volatility. It's too much of a black box. You don't know the cost of goods sold until after the fact. I mean, if you're selling steak au poivre and you don't know the cost of the steak till after it's a problem. Look, nobody wants to go back to 2007, but right now the pendulum swung too far. Same investor survey, 9 out of 10 investors find regulation too strict. Too much marginalization of banks. If you look at loan growth by decade, the last few years it's been flat to negative, inflation adjusted. Too much disintermediation, marginalization of banks, too much business leaving the banking system, and too much disregard of de-risking. 15 years. You've done a great job, regulators, as of 10 years ago. You've doubled capital roughly. You've doubled liquid assets. Banks have not stretched for loan growth. But as I learned here, I learned my best lessons here at the board 35 years ago. If it grows like a weed, maybe it's a weed. Banks have not been growing loans like a weed. And look at what the $7 trillion investment-grade bond market says about bank safety. They're saying banks are safe. In fact, they've said banks are safe for most of the period for the last decade. And it's too costly. These are our best estimates, but roughly 20% of bank expenses are related to regulatory, compliance, cyber, all in. And then when we poll large banks, they think they could maybe save 10 to 20% of that. So you're looking at a possibility of saving 4% of expenses. And in our investor survey, what investors are looking for are greater efficiency from regulation and greater loan growth. And there's too many moats around the largest banks. Talk about unintended consequences. By the way, when I worked in the application, the merger group here 35 years ago, we would approve mergers in 60 days. And we had one review said I looked at 100 applications in a year or something. And the unintended consequence is, fine, I'll just keep increasing my price targets on the largest banks. We should have more trillion-dollar banks to compete against JP Morgan. Goliath is winning. They're gaining share. And then there's the loss of talent. For every executive that comes in the banking industry, 5 are leaving. Talent drain. So 10 unintended consequences. Too much regulatory risk, complexity, targets, volatility, marginalization, disintermediation, expenses, loss of talent. But there's hope. Let's see if this works here. The hope is this. I had to bring children's scissors to fit through the metal detector in the airport. Well, this is the hope, okay? That's the hope. And the end result here then is just win, win, win. Regulators, you can have more efficient oversight. The banks, yes, they'll be more profitable, more efficient, but the customers will have better terms and more options. So with that, I was going to hand this over to Phil, who can describe how we got to the state in Basel III.
Oh, blimey, I think I'm going to be a bit less entertaining than that. So I thought I'd take this two ways, basically. So I talk first about the benefits of having a kind of an internationally aligned approach. What benefits does that give us in general terms? And then I'll get on to the specifics about why this Basel Endgame package is, why are we doing it? So on the general, and I guess this is one of the key points I wanted to get across today. I mean, I'm going to argue that international standards are things that we benefit from. The reason we do them is we get benefits. And there are many that you could talk about. The two that I would pick out are, in terms of, first, international financial stability. So we are and still remain so interconnected that when something goes wrong globally on financial stability, it affects everyone. And those costs are deep still. And the second is on the role of international standards promoting trade in financial services. So, you know, large global banks have economies of scale and scope, and part of the way they get those is having similar rules across borders. So it's what allows domestic banks to operate abroad and foreign banks to operate domestically. So that's the general. What about the specific on Basel Endgame? So as Rob said, our version of that is called Basel 3.1. So we couldn't quite bring ourselves to call it Basel 4, and so we had like a tiny eeny weeny Basel 3.1. But my guess is we were looking for the same kind of comfort blanket that you guys were when you called it Basel Endgame. It's part of the post-GFC reform package, so it's the third bit. First two bits were about the quantum of capital and then the quality of capital. So quantum we've done already. So I don't think that the Basel Endgame package needs to be about the quantum of capital at all. What is it about? It's about measuring risk better, right? So the standardized approach we have at the moment, the standardized approach is always going to be blunt, but it's just very blunt, the one we have at the moment. And so we're kind of tilting it just so that it picks up risk better for the right activities. And that is important in its own right, but it also has benefits for competition, because one of the things that we feel strongly in the UK is that smaller banks have been unable to compete on low-risk activities because they're forced up the risk curve by this very blunt standardized approach. And so a big benefit is to improve competition. On the model risk weight side, we kind of lost confidence in that a bit. So we had these papers post-crisis where we were running experiments. We gave firms the same, exactly the same scenario, run it through your models, and they throw out completely different risk weights. And that kind of drains confidence. So one of the things we're doing in this endgame package 3.1 thing is a bunch of things to try and bring back some of that confidence again, so, through things like the output floor. So I'd argue there's a lot to like about international standards in general because they give us benefits, but this particular package is balanced and gives us some good things.
All right, well, thank you very much. As everyone in this room knows, this is not the first time we've taken a run at Basel Endgame. So I'd like to ask Randy to start off and give us a sense of what were the mistakes that regulators have made in the past? What are things that should be avoided now as they craft this again?
Well, I guess it depends on when in the past you're talking about. Because there have been a few efforts, and some were better than others, as it turns out. But so I think there are, with respect to what ought to happen in finishing the implementation of Basel III, I think there are substantive issues and there are process issues. The first substantive issue is that these measures, even in Basel, as Phil mentioned, this isn't about the quantum of capital, and it was not about the quantum of capital when these measures were being discussed in Basel. It's about the incentives that the overall capital framework is creating, and they were not intended to increase the quantum of capital, and I think that should be a first principle of implementation here in the United States. Not just because it's sensible, it's also Basel compliant. It's not intended to increase the aggregate amount of capital in the system. I think, and there have been proposals around implementing Basel III that would have done that, and I think that, I think that that was the wrong direction. As a matter of process, I think it is a mistake not to get as much input as possible. And so this conference is a paradigmatic example of how one ought to go about the process of the implementation of these last measures of Basel III. From all sorts of areas. More heads are better than one. I think there have been folks who have said, look, here's a proposal. If you don't like it, vote no. And that's, it is a better process to have gotten input from everybody in this room, folks outside of this room, academics, banks, public interest. I think banks are part of the public interest, but a wide range of groups. And I think if you combine those basic principles, then there can be a successful result. I would add that I do think there should be a successful result. I've heard, there have been threads over the course of the last several months that maybe we just drop these last measures of Basel. And I think that's not in the interest of the United States. Bill makes a good case for, global financial stability. I used to be a global financial stability guy. I have nothing against global financial stability, per se. But the Basel process, particularly the Basel capital process, has really always been in the fundamental interest of the United States. Hal Scott mentioned that the very first Basel was because the Japanese banks were being allowed to operate with $12.73 of capital, and they were hoovering up all the business in the world, literally all the business in the world. Those of you with gray hair around here will remember the late 80s, and it was like US banks could not compete because the Japanese banks did not need to have any material amount of capital. And so the first Basel effort was to say, globally active banks will have globally consistent capital levels. Now that was, it was crude and simple, but it was a first effort. Then during the 90s, the European banks were operating with much less capital than the American banks, and so Basel II was this complicated effort to create an intellectual framework that would justify allowing the US banks to lower their capital to the levels of the European banks. The math club went to Switzerland. It was extremely difficult to understand, but people felt confident at the end that the capital could come down. No sooner was that done than you had the great financial crisis. Whoops, wrong direction. Capital needs to come up instead of down, and Basel III has been ensuring that particularly the Europeans, but global capital levels in general, are consistent. If you don't like what's coming out of Basel, what I say to the folks who wear my political football jersey, who believe that we go into these fora and are snookered by the wily Europeans, it's like, that's not what happens at all. If you don't like what is coming out of Basel, it's because you don't like what the US took into Basel. We generally get everything we want out of Basel in order to create this level playing field. And if we didn't have Basel, we would all be subject to these same rules because that's what we took in. And the rest of the world would not. So I do think it's very important that following these principles of not increasing aggregate capital, doing it in a sane and smart way, getting a lot of input on the technicalities, that we do finish the implementation of Basel.
Well, thank you. Shira, do you want to weigh in on where you think the mistakes were in the past?
Sure. Thank you very much. And I agree with everything that my other panelists have said. I think it's important to take a step back in light of the history journey that Randy just took us on and recognize that what is attempting to be done in Basel III Endgame is what's transpired over the last 4 decades and 4 iterations of changes to the capital framework, in that it addresses every component of the risk-weighted asset calculation and the ratio construct themselves. So it's a significant book of work, and some could argue the most significant book of work. And in my mind, there were 2 flaws in the design of the original NPR, both of which relate to isolation. The proposal was done in isolation of the other components of the capital framework, and the proposal was done in isolation relative to what was being done internationally. So as it relates to the capital framework, what's unique with the United States relative to every other major jurisdiction around the globe is that the stress capital buffer is a Pillar 1 requirement, which means it's included in your capital ratio requirements. And therefore, when you're going to overlay Basel III Endgame with the stress capital buffer, you need to be extremely mindful of the capitalization included in each, affecting the same asset class or markets or products. And it didn't appear as though, based upon how the NPR was proposed, that that was done to a sufficient level. So that's one component of where it was done in isolation and I think didn't calibrate correctly. The second is it was done in isolation relative to the rest of the world. And there are components that was included in the NPR that no other jurisdiction in the world implemented. So for example, the SFT minimum haircut floor was included in the NPR. No other jurisdiction has implemented it. The public listing requirement to get an investment grade rating was not implemented in any other major jurisdiction in the world. And so as a result, it's not surprising that 97% of the responders to the NPR were against it in some way, shape, or form. So the good news, and part of it is the energy that you're feeling in this conference, is the Federal Reserve has the opportunity to repropose Basel III Endgame, and I agree with Randy's statements that it should be on the docket of the many things that Vice Chair Bowman needs to do. But the good news is Vice Chair Bowman specifically has discussed the importance of looking at capital holistically and the relationship between all the different components. And then from an international perspective, because most jurisdictions are further along in implementing Basel III Endgame, you know the answer as to what every jurisdiction around the world has done, and that can kind of start as the blueprint as to how the Federal Reserve wants to repropose.
Well, thank you for that. I think since it's entitled The Evolution of the Capital Framework, I want to know what would a successful Basel III Endgame final rule look like? I mean, how would we know if we'd succeeded in what we're attempting to do here?
I'm happy to start and others can weigh in. Every time a new capital rule is put into place, whether it's in the US or internationally, what essentially is being balanced is safety and soundness versus growth, innovation, capital markets, et cetera. And so in theory, you're weighing, and the regulators are weighing those two things in making all of the decisions around capital implementation. And so to the extent that the only thing you cared about was safety and soundness, you could make banks hold infinite amounts of capital. And as a result, you wouldn't have to worry about safety and soundness. But what would be the other side of that? Corporate bond underwriting would come to a screeching halt because there would be nobody available to underwrite. Corporations that want to hedge their interest rate risk or their commodity risk or their FX risk have no counterparties that they can face. Mortgage lending, credit card lending, et cetera. And so it's really about striking that balance between economic growth and safety and soundness. And so when you look at the way in which most other jurisdictions have implemented Basel III Endgame, they've really tried to achieve that balance. And in some ways, it comes back to that capital neutrality point. And so there are certain components of the rule that they've implemented that incentivizes economic growth. As an example, most jurisdictions have exempted end users from the CVA add-on included in Basel III Endgame. And that's to protect those corporations from the burden of the banks carrying increased capital associated with facing them as a counterparty. Many jurisdictions have not applied the 400% risk weight to public equity, to private equity, to all private equity, but limited it to speculative private equity so that banks can continue to participate in more mature private equity, which is often on the precipice of them ultimately becoming public equity. And so to me, a successful Basel III Endgame has appropriately balanced safety and soundness, which is obviously incredibly important, but also economic growth.
Randy, do you have a view? What does success look like?
I think that was a pretty good overview of what a successful implementation would look like. The purpose of these last measures is to create incentives with respect to bank activity without increasing the capital burden, if you will. And I think if you see bank activity modifying appropriately in light of the areas where these new capital requirements are being implemented, in a way that is supportive of economic growth, but you actually see, okay, well, the banks are changing their, we have in fact created incentives. We're seeing that the incentives are operating appropriately, and we haven't increased the overall capital burden on the system. That's a success.
Phil?
Yeah, I mean, so the best way for me to answer that is to couch it in terms of the way we tried to construct our own implementation of this. So I guess there were three things. So one was from the bottom up, activity by activity. We weren't looking for too little capital, but we weren't looking for too much either. So that a kind of fair amount of capital, if you like. And then top down, we had a view that there was enough capital in the system, so this wasn't meant to be about looking for more capital overall. And then third, we were looking for international consistency. So we were monitoring what other people, what other countries were doing. So what does a good one look like? I think it looks like those things coming through. So the playing field looks level. We've got consistency across jurisdictions. We're looking to make sure that capital isn't rising. So one of the things we'll probably get onto this when we talk about stress testing, is we had a principle from the beginning that we shouldn't double count. So if there was something where we were holding capital previously in some part of the stack, and now Basel 3.1's coming in and you're holding it in Pillar 1, and it's the same thing, then you don't need to hold the capital twice. And that was a principle that we tried to build in from the bottom. It's easier said than done sometimes, so it's not always obvious what is a double count. Final thing I'd say, so I do think there's something in this for small firms. So the risk sensitivity that I mentioned, I think, is a good thing for small firms on the standardized approach. And so I think we'd be looking for in our implementation just a bit of the leveling the playing field between small and large firms. That's it.
And most importantly, less loans to the shadows.
I think one of the things that, Randy, you just touched on was this idea that what happens if the U.S. doesn't complete Basel III Endgame, and there have been some lawmakers who are concerned about the international framework as if we're deferring to international regulators of what to do here. So let me just ask each of you, what happens if the U.S. just decides not to implement Basel III Endgame and lets it go?
Yeah, an important question. I mean, I guess the first thing to say is I hope that doesn't happen because so speaking for the UK, we get tremendous value from our close collaboration with our US counterparts. It really does make a difference to have the US as an integral part of the international community. I guess a bit more concretely though, so I haven't really seen evidence of that, that it's particularly likely. So like my reading of the consensus is that it doesn't seem very likely. And I guess at one level, I don't find that surprising because in the way Randy and I have tried to describe the benefits of kind of being similar across jurisdictions is good for global financial stability. It does help with leveling the playing field. And, these are all things that we recognize, that the US recognized when this was being negotiated in the first place. So I'd argue that banks, large US banks, as well as UK banks, benefit from that consistency. So you'd want to do it, I think is what I'm saying. So all of that explains why we're a long way down the track in terms of our implementation. But so, I mean, given those arguments, if the US really didn't implement, obviously that would be a major issue. And I think it would be wrong to deny that it would be a major issue. So although I think there are strong drivers to get Basel Endgame done, we'd have to cross that bridge when we come to it. But I know the US authorities that we speak to anyway understand that very well.
Sure.
Yeah, I was just going to kind of agree with my panelists. I think that although my perspective is obviously different as a practitioner, the importance of having the banks around the world on a similar and consistent capital framework, recognizing that it can be gold-plated in some jurisdictions versus other, and on all things that need to be addressed and discussed, that I do think that it's important that the U.S. implement Basel III Endgame to be consistent with the other banks around the world.
Randy, anything to add to what you said earlier?
Yeah, I think the principal consequence would be when we get to Basel IV, which we will There will be new issues in the future. We will learn things about the financial system will evolve, the banking system will evolve. There will be a need to evolve the capital framework in light of that. Other issues will arise, and we in the United States will once again say, if we want to have a fair playing field on which to compete, there are some changes we need to make, and we want them to be made consistently. And if we have not implemented Basel III, which was very much driven by the United States, we will walk into that room and people will be much less willing to listen to us, since we were the Lucy that pulled away the football the last time.
Mike, do you have anything you want to?
Get it done, get it done, get it done. If you don't, then the cost of capital for banks would be higher than it otherwise would be.
So I want to spend a little time. There's an entire panel about the stress test, and I don't want to steal their thunder, but I do want to talk a little bit about the interplay between Basel III Endgame and the stress tests and what the relationship should be. So Shira, let me start with you. What should the relationship be between this?
Sure. It's a great question. It's something that gets a lot of discussion. As I mentioned earlier, the U.S. is unique in that the stress capital buffer is part of our Pillar 1 requirements or part of our ratio requirements, and therefore requires a higher degree of sophistication when combining that with Basel III Endgame, because you have everything that's been capitalized in the CCAR stress test, and then you have things that are being capitalized for in Basel III Endgame, many of whom are double counts across them. So in my mind, the most egregious example is operational risk. In the results that the Federal Reserve released last month on the CCAR stress test, they included $180 billion of capital associated with operational risk losses on the banks that participated. And so therefore, that $180 billion has been capitalized for in the bank's ratios. When included in Basel III Endgame, it reintroduces operational risk into the risk-weighted asset framework. Currently, today, that only sits in the advanced ratio, so it's not part of the standardized ratio, which is the more binding ratio for the banks. And so included in Basel III Endgame is operational risk-weighted assets. In the estimates that the banks provided in conjunction with the NPR, the amount of capital associated with those operational risk RWAs was around $150 billion. And for those that don't know, operational risk is capitalizing for, generally it's legal losses, that's kind of the biggest driver, but it includes any sorts of costs associated with outages, climate-related events, et cetera. It's all captured in there. So when you take the stress capital buffer loss of $180 billion, plus Basel III Endgame RWAs of operational risk, which is around $150 billion of capital, what the original proposal did is just put those two numbers on top of each other. And so the question that every constituent should ask is why is it necessary for banks to hold $180 billion plus $150 billion of capital associated with operational risk? And if you look at history and just focus on the GSIBs, over the last 10 years, so decade, the GSIBs, and I can only speak to legal losses because operational risk losses are not in the public domain. The GSIB legal losses has not been $180 billion. It's not been $150 billion. It's been less than $100 billion. And that's over 10 years. The CCAR stress test is only 9 quarters. And so I use that because, again, I think it is the most egregious example. But you can look at market risk. You can look at CVA. You can look at lots of different components. And the challenge for the Federal Reserve is to look at what's being capitalized for in the stress capital buffer, which is unique, and what's being capitalized for in Basel III Endgame, and making sure that they're not double counting things.
Randy, can you, the stress capital buffer was finalized under your watch at the Fed. Can you take us through why it's better than the CCB was and why it's needed now?
So I think that there are two parts to that answer. One is a legal part, sort of general legal principles part, and the other is a practical part. So before the stress capital buffer, and I hadn't realized this until I walked into, well, it wasn't this building, it was the one across the street, which now may never be built. But before the stress capital buffer, the outcome of the stress test, the practical outcome of the stress test, depended on what the Board of Governors had had for breakfast on the morning it was presented to them. And that does not seem to be the right way to operate a regulatory system. That's going to have such consequences for the regulated. So the basic legal principle, it seemed to me, was that the consequences of the stress testing process should be clear and concrete and measurable. They should be legal as opposed to entirely discretionary. And I should state that I'm a big fan of stress testing. During the COVID event, the fact that we had stress tests, and we ran 7 stress tests in the United States during that period, allowed us to be very confident in the resilience of the banking system during that whole time, and allowed us to continue to allow our banks to pay out dividends when the rest of the world had suspended them. And our banks are benefiting from the lower cost of capital that comes from that predictability of return even today, many years later. So stress testing, good in general. But there should be a predictable outcome. The practical side of the question to me for the SCB as well is that if it depends on what you have for breakfast, different people at different times have different breakfasts. And the potential consequences of the same stress testing outcome, depending on the particular people who have been appointed to the Federal Reserve at any point in the future, could be dramatically different. If you've left that open, you've essentially left it open to the vagaries of the political process if you don't have a concrete consequence for the outcome of the stress test. Over a long period of time, the Fed is a marvelously apolitical institution. As a citizen, I've been very, very pleased with my involvement with it to see how true that is. But the people are appointed through a political process, and over a period of time, you could have significantly different outcomes for the industry. So I think both for general legal principles of regulatory action should be subject to discipline, and the stress capital buffer makes it clear what that discipline is, and and predictability of results over time. That's how the outcome of the stress test should be implemented, is through some sort of a stress capital buffer.
Mark, you look like you have something you want to
Well, I just want to put an exclamation point for what Randy said. I mean, having had the stress test in April 2020 or spring of 2023, we felt confident, I think a lot of investors felt confident, that banks could withstand whatever was coming their way, the largest banks.
If the agencies agree that the fundamental review of the trading book plus the GMS and the stress test hit bank trading books with excess aggregate capital requirements, what is the best path to reducing that surplus? Should we soften the GMS or look to soften the FRTB domestically or in Basel? Shira, you want to? I'm gonna volunteer you because you have the red light on your microphone.
I heard FRTB, and that's like magic to my ears. So I figured it was coming my way. My takeaway from Randy's talk as to relates to how the SCBs are derived is that I should have gone to culinary school instead of becoming an accountant. Would have been better for Goldman Sachs. But with that said, the FRTB, and for those that don't know, that stands for Fundamental Review of the Trading Book. That's the market risk component of Basel III Endgame. And the Global Market Shock, or GMS, which is included in the CCAR stress test, is the instantaneous shock to the trading businesses of the largest banks. And so your question underlies the issue at hand, which is that there's a duplication between how FRTB is shocking market risk and capital and requiring capitalizing for market risk versus the GMS. And if you dig even deeper, they both kind of do it in a similar-ish framework. They're both looking at the same position set, and they're looking at tail risk, so they're shocking it to like the very tails in terms of how those markets would be affected. And then, again, in the original proposal on Basel III Endgame, stacked those two things on top of each other. And so to your question, to the extent, as the Federal Reserve is looking to repropose Basel III Endgame, as well as, all the work that's being done on the CCAR process, I think both stand to benefit from a really deep dive to ensuring that the shocks and the assumptions and liquidity horizons that are being used in them are consistent. And I'll use an example that I think highlights it. The GMS still uses assumptions from the financial crisis in terms of the level of shocks, despite how far we are removed from the financial crisis, and more importantly, how much reform has happened since the financial crisis. So as an example, using securitized product, so this is the underwriting and packaging of mortgage-related or asset-backed or CLOs, taking all those assets together and issuing them as bonds. The shocks that the Federal Reserve applies in the most recent CCAR stress test, so the one that we just got the results of, are equal to the shocks that banks, that those assets suffered during the financial crisis. What that doesn't account for is the fact that the LTVs of those loans are significantly different. The FICO scores of the borrowers are significantly improved. And so the shocks are being applied to bonds and assets that are much better underwritten or subject to much better underwriting relative to the products that were being traded in the financial crisis. And so I do think that the GMS is very ripe for that, to get that overhaul, because it really hasn't been addressed, since it was first put in place. And one of the ways in which the calibration is off is to the extent that you take an asset, a securitized product, and subject it to both FRTB and the GMS. About 15% of the product that was underwritten last year, banks would be required to hold more capital than the carrying value of that asset. So I would have a bond with a carrying value of $100 million, and if I added FRTB and the GMS to it, I would capitalize that for $120 or $130. So the capital that I would hold is greater than the carrying value, such that if I wrote that bond down to zero, I'd actually release capital. And so it's an example of where you can look at it quite simply and see that the calibration is off. And as I mentioned, this isn't one or two bonds. This is 15% of the market that was underwritten last year.
So one of the arguments that Treasury Secretary Scott Bessent brought up last night was talking about whether or not firms should be able to opt in to Basel III Endgame, those that are not covered by it. And I guess I want to get the panel's view on, are there pros and cons to including them versus not allowing them to be included if they want to, and what the system looks like?
I'm a libertarian. And I'm nobody's mother. I mean, if they want to opt in, I don't see a downside, except potentially from the institution, and that's theirs to judge.
Phil?
Yeah, so this is a question about whether you apply the rules to small banks. So Basel 3.1 was agreed internationally, so clearly applies to the largest banks. I've argued that it's better than what we have now, so I think you'd want to apply it to mid-sized banks for us. The question is, do you apply it to the very smallest banks? So in the UK, we've long wanted to have a kind of a more proportionate regime for smaller banks, and now that we have left the EU and we can write our own rule book, we've been working on that. So we call it strong and simple. In homage to Mike. So we had to decide whether to take Pillar 1 from Basel 3.1 and give it to the very smallest banks. In the end, we decided we would because we just felt it was better. We felt it enabled them to compete more. The caveat was that where we saw that there were parts of the new Basel framework where they just didn't need the rules because they didn't do much of it, like trading book rules, CVA, counterparty credit risk, all of that kind of stuff. We said, you don't do much of that. That's how you got into the strong and simple regime, and so you don't need to worry about those rules. So we carved them out of that, but the rest of it we did. So we have. I think it is possible to give the Pillar 1 to smaller banks, and I do think they would benefit from it.
One of the things in my former life when I was editor at American Banker, we used to talk a lot about capital standards always inadvertently pushing banks out of different activities. So, can you talk about the extent to which there are dangers in Basel III Endgame of doing that versus, how can we morph capital requirements to bring some of the activities that were in the past possibly pushed out by these capital requirements back into the system?
I'm happy to start, and others can weigh in. I think that your question is 100% right, and we've seen it time and time again. No matter how big or how small the rule is, as the capital framework continues to evolve, you're able to pretty clearly see the impact of what it does to the broader market as a result. So when, mortgage lending related requirements were gold-plated, you immediately thereafter saw an uptick in the amount of mortgages being underwritten outside of the banking system. Most recently in the implementation of SACR, which is the counterparty credit capitalization requirements, which is actually part of the Basel III Endgame, those rules changed the capitalization for short-dated derivative hedging. And as soon as that rule came into play, you started to see that activity move outside of the regulated banking system. And so that unintended consequence of the amount of activity kind of almost immediately responding. I mean, you even see it in CCAR shocks, where if in a particular year the Federal Reserve shocks are more punitive to something specific from an asset class perspective, you will see banks will do less of that and it will move outside of the regulated banking system. And so that's something that needs to be really carefully thought about in conjunction with all the components of the capital framework that the Federal Reserve is looking at, whether it's the stress test or Basel III Endgame or GSIB, that to the extent that you're increasing the capital requirements on particular products for the most highly regulated banks, that activity will go somewhere and it will go out to the less transparent outside of the banking system.
Randy?
Yeah, I do think that is something that has heretofore across a broad range of eras and people and regimes been given insufficient attention in thinking about bank regulation. Is that especially in the United States, but now really even very substantially globally, it's a financial system. It's not just a banking system. And if we adopt regulations that are going to push something out of the banking system, it will go elsewhere. We will not really constrain that activity. You have to think, and we will push it into either parts of the financial system that are less transparent and less well capitalized, or jurisdictions that are less transparent and within the banking system that are less transparent and less well capitalized. So, and there really has not been sufficient attention, I think, given to that holistic view. The growth of private credit in the first instance was really driven by regulation. I think it's now growing for reasons that are outside of regulation. I think actually there are reasons to think that the growth of private credit is probably stability enhancing because the vehicles through which private credit is provided are less subject to runs, and an ecosystem is developing where the banking system and the non-bank private credit system are working together in a way that allows more visibility from the bank regulators into the overall financial system. I think it's working well now, but there's the fact that it's working well, there's no particular reason to have driven it out of the banking system, and the bank regulators should think about, if a bank can do this lending safely, it should be allowed to do it safely, even though the private credit system is not, in fact, I think, harmful in any way.
Well, we have a brief few minutes before our panel ends, so I have more than enough questions that I can keep going, but trust me, question right up here in the front.
Thanks. I want to take us back to some of Mike's slides in the beginning, where you painted sort of a picture of utopia, a city on the hill that would be both strong but simple. So if you were going to try and move us from where we are today towards both simplicity and strength, are there one or two things you say these would be the best moves to get to that city, both for Mike and for others?
Well, I call it balls and strikes. I don't set policy. So I'll let you know once I see it. But you know, when I talk about it being confusing, it's not just confusing to investors. I bet it's confusing to bank board of directors too, and bank execs, and frankly, probably some regulators. When I talk about it being constraining, you know, let's banks be banks. When I talk about it being costly, I mean, that's an easy one, and we all see examples of that. But I think, you know, two themes have come up. Certainly holistic approach to capital. Second is the idea of level playing field. But I'd add a third one, and that would be dynamic regulation. Because we're going to have more bank failures. There's going to be more bank crises. You know, that we all know that. But they don't repeat, right? You had lending to South American countries, and then you had commercial real estate, and then you had long-term capital, and then you had global financial crisis, and then you had Silicon Valley, and the next one's going to be different. So I like the idea of having examiners also being accountable in a decentralized way, as opposed to ivory tower academic setting models. So I think a degree of humility about what we can do. And when I was here 35 years ago, there was Bill Taylor, who headed bank supervision regulation. He was the best. And he was like, you know, be tough on the things that matter. That's capital, that's liquidity, that's what keeps you solvent. So that's my template for it, but I'll leave it to the ones who practice and do these things for the policy.
The good news is, you know, we're having a conference like this like we've never had before. And when you look at what Vice Chair Bowman's done over the course of the last few weeks, it's more change than we've kind of seen in both the recent past and even longer. You know, I think focusing your question particularly around the CCAR stress test, you know, we are pleased with what the Federal Reserve has done thus far in terms of enhancing some of the disclosure around the tests, and also talking about their willingness to put the scenarios and the models out for public comment, because we think that transparency is really important. As the firm with, I would argue, probably the most volatile stress capital buffer, I agree with Mike's points. You can imagine capital planning is very difficult when your requirements could change year over year by north of $10 billion, even though your business model is relatively consistent. And although the averaging NPR is meant to address that volatility, it doesn't actually address the fundamental or the root cause of the problem. The root cause of the problem is the scenario and shocks, which we've talked about, that really haven't been calibrated for all of the regulatory reform, the Volcker rule that we talked about in the last panel, mandatory margin and clearing, and all of this uplift that's been done to the regulatory environment, such that the shocks that existed in the financial crisis should. And then the models, again, we don't have full transparency around them, although we look forward to that, don't respect some of the observed correlations that exist that we've seen it happen time and time again. Example around trading revenues. All the most recent crises have proven that in times of volatility, trading revenues increase because there's more activity and bid-offer spreads widen. Nevertheless, when the Federal Reserve models trading revenues in stress, they don't include that assumption. And so I think that we're on a really great path, but that's some of the more particulars that need to get addressed.
Jarrett, over there.
Yeah, hi, Jarrett Seaberg with TD Cowen. I'm going to regret saying this on camera, but I actually agree with Mike that I think most of the market doesn't understand bank capital rules. And I think we run into a problem where there's such a push for tailoring. We hear that over and over on Capitol Hill. But that means that we have even more sets of rules, and we don't quite know which banks apply, are covered by which sets of capital rules. I wanted to focus in particularly on available for sale securities and whether those unrealized gains and losses should run through capital. I was hoping the panel could talk a little bit about why that's only for the biggest banks, and should it be pushed down to all banks?
That's a good question. Does anyone want to jump in there first?
So it's, I probably shouldn't have pushed that button because it's been because it's been a few years since I engaged on the question. But it's harder than it sounds because to the extent that you push changes in the available for sale securities account through capital, then you create a strong incentive to move those securities to the hold-to-maturity account. And once they're put in the hold-to-maturity account, they are, as a practical matter, quite illiquid. So when the Federal Reserve, this was long before my time, this was under the Saint Dan Tarullo's time, considered this question, that incentive was very important in saying, okay, well, we shouldn't do that for most banks in order to create this kind of incentive for structural illiquidity on what should be liquid securities. Of course, the problem is that those available securities do change in value, and that can have a capital effect. If you take, however, Silicon Valley Bank just as an example, where that was the most recent instance where this issue was considered, and people said, well, why shouldn't we have been requiring them to increase capital as the value of their securities was increasing? Actually, if you'd had such a rule, that would have created incentive for them to push much more of their available for sale securities into the hold-to-maturity account, and it was the fact that they had all of these securities in the hold-to-maturity account that was concerning, because they couldn't liquidate those, and it was that overall position that was causing the concern about their overall solvency. So you actually would have worsened the Silicon Valley situation, most likely, by creating that incentive for them to put even more of their liquid securities into hold-to-maturity. So, how do you address that? Well, you could say, all right, well, for banks, we're going to require you to take the changes in value of both of those accounts into account for your capital. But a long time ago, the bank regulators decided, I think on balance correctly, that the regulatory accounting regime had diverged so much from the generally accepted accounting principle accounting regime that it was now, that there were a lot of pathologies associated with that, and that the bank regulators would rely mostly on on FASB standards for determining what would be income, what would not be income. I think that's still correct. People have gone to FASB for a long time, even outside of the banking rules, to say that hold-to-maturity securities should be treated differently, and they have decided not to. Again, because it's not as simple a question as it sounds, and so until they do, I think that that balance that's currently being struck about what to do with accumulated other income or what to do with the treatment of available for sale securities is two ways of saying the same thing is correct.
Well, unfortunately, we are at time, but I want to please join me in giving a round of applause to these panelists. Thank you so much for being here. Thanks again to the Fed.
Start. Okay, welcome to our next panel. We've got a tight schedule today, so we're going to start. My name's Anil Kashyap. I'm a professor at the University of Chicago. I've got the pleasure of moderating. I want to thank Vice Chair Bowman for putting together such an excellent panel and a fantastic program overall, so thanks for including me. I'm joined by 4 people with different backgrounds and perspectives for this very non-controversial topic about the GSIB buffer. So we're going to start, I'll just go down the line here. So Steve Chubak is the managing director at Wolfe Research, one of their, leads their bank analyst team. You're going to see some of his numbers later on. You'll see why it makes a good deal of sense to have him here. Wilson Irvin, it says former chief risk officer at Credit Suisse. He wants me to remind you that that was some time ago. You might know him as the guy that I think of as inventing COCOs, really. I mean, that came by a push from the industry, and Wilson was central to all of that. He was recently at the Treasury as well, but now he's just a private citizen, so he can say anything. Al Moffett is the global treasurer at JP Morgan Chase. Been there for 18 years and has seen many parts of the business. And then finally, Andrew Ullman is the managing partner of the DC office of Mayor Brown, but he also has worked as a Senate staffer and was in the White House at the National Economic Council. So we've got a diverse set of people here. And so without further ado, Andrew, you're up.
Thank you. Well, first of all, I want to thank the Federal Reserve and Vice Chair Bowman for organizing this conference. I really do think that such forums such as this are critical for building consensus around important policy reforms. so that they're durable and that they're well thought out. So thank you for having us today. I think it's especially important on the topic today of capital regulation, because capital requirements are the cornerstone of financial regulation, and that's critical that they're properly calibrated. So I think it's kind of appropriate that we start this discussion on the GSIB surcharge, but I think this discussion also is relevant for our larger conversation today on capital requirements, to start with understanding the statutory framework, because as much as what happens in Basel is important, what Congress does is the most important, and it sets the parameters on what policy makers can do and what they should be doing. And so to start is the key statute here governing the GSIB surcharge is Section 165 of the Dodd-Frank Act, which was mentioned earlier today. And that section requires the Fed to impose more stringent prudential requirements on bank holding companies with assets above $250 billion or more, including more stringent capital requirements. Now, Section 165 was adopted as part of Congress's effort to increase capital requirements for the largest institutions, but generally throughout the financial system in the wake of the global financial crisis. Now, what's important to note about Section 165 is that it functions to build off of the Gramm-Leach-Bliley regulatory framework that was adopted in the late 1999. Gramm-Leach-Bliley, you may remember, was the statute that allowed banks to affiliate and have with securities firms, insurance firms, and allowed holding companies to have material non-bank subsidiaries. That model is allowed for the creation of much larger financial institutions that could offer a broader range of financial services. Now, at the time Congress was debating Dodd-Frank, it did consider several proposals that would have undone the Gramm-Leach-Bliley framework, including reinstating Glass-Steagall or imposing limits on the size of bank holding companies, but it did not adopt any such reforms. Instead, what it did is through 165, it required the most complex bank holding companies, the ones most likely to have significant non-bank subsidiaries, to hold more capital at the holding company level. Implicit in this policy decision was that by requiring more capital at the holding company level, such institutions would be in a better position to address any issues with bank or non-bank subsidiaries. So this already reflects on our kind of the earlier panel talking about the leverage ratio and why having more flexibility for capital at the holding company level is a useful thing. Well, it's not only a useful thing, it's also what Congress contemplated in the statute. Now, Congress granted the Fed pretty broad discretion on how to implement these heightened prudential standards, including capital requirements. But it did impose some really important conditions. The first is it required that the enhanced prudential standards, including capital, be tailored. And tailoring's got been a kind of a buzzword that's been going around this town for a long time, but it is in the statute because Congress did want to avoid creating one-size-fits-all regulation with heightened prudential requirements, including capital. And the reason for this, one of the key reasons, was that it did not want to have these heightened capital requirements impact banks' operations of other key services, including like capital markets activity, custody services. So there was recognized that there was a cost that came with heightened prudential regulation. Second is that under 165, capital standards are to increase in stringency gradually and is appropriate in relation to the company's size, leverage, and other measures of risk. In other words, there is supposed to be a smooth application of prudential standards and capital, somewhat similar to what we have under the GSIB surcharge now. However, Congress also specified that it didn't want to have small changes in risk that would result in sharp, discontinuous changes in prudential standards. In other words, it wanted to address and minimize cliff effects that could come from having too big of buckets on the application of capital standards. Now, there's a second reason Congress also wanted to have this gradual application, and it is a little bit of the skunk at the GSIB surcharge garden party, which is, and I'm going to quote the language from the Senate Banking Committee's report on the bill that became Dodd-Frank, is that they wanted to have gradual application, quote, to avoid identification of any bank holding company as systemically significant. So current model may be a little off on that one. And certainly, the late Justice Scalia would have said, well, that's only legislative history, and it shouldn't matter. He has a little point in that. On the other hand, it is very clear that Congress did not want to have any enhanced prudential regulations to clearly signify that any institution was too big to fail. Now, the third restraint and requirement that Congress put in 165 was that these capital requirements were supposed to be part of a broader range of heightened prudential standards, some which have already been mentioned today: resolution plans, stress tests, leverage, liquidity requirements, and that they were all to work together. In other words, the GSIB surcharge was not supposed to be a big tax or a standalone capital charge that did not reflect all of the other heightened prudential requirements on institutions, bank holding companies above 250. It should all work together. So I think going forward with that framework, what it means is that there's a fair amount of flexibility, but there are some important constraints that Congress wanted the Fed to think about when it imposed these heightened prudential standards.
Okay, thanks. So before we go further, I want to just, I'm figuring most of you don't spend your time studying method 1 versus method 2 to calculate the GSIB surcharge. So before we get into the further details, I'm going to just give you a little bit of background. There are two ways, two alternative formulas. There's the one that was agreed in Basel, which we're going to call today method 1, which tries to figure out the basic point here is the more interconnected you are, the higher was to be your capital standard. And there's a Basel agreement that has 5 indicators that I've listed there: complexity, size, interconnectedness, substitutability, and cross-jurisdictional activity. And you're compared based on a set of global peers each year. The Fed, 10 years ago, went in a slightly different direction for reasons that we can revisit, but there are 2 things that I think you should realize now. One is that it doesn't have exactly the same 5 indicators. It's instead probably burned by the GFC, where there are all these runs. Reliance on short-term funding is in there. There's no cap on any of these things in method 2, which is what's being used now. In method 1, the substitutability factor is capped. And then perhaps most importantly, I think Steve will talk about this when he gets there, is these 2 methods have diverged. If you just look over time, the Fed's method takes data from essentially 2012 and 2013 and benchmarks against that. And so as this banking sector has become bigger, the method 2 charges have risen. So if you look over time, this is one of these beautiful charts from this report that Stephen just put out, shows in the top method 1 and in the bottom method 2, and this is as of 2016 versus now. These things all come into effect with a lag, but you can see that there's a time trend. All the gray bars in the bottom picture are higher than the blue bars, which means over time there's been an increment, and this feeds to what Andrew was just talking about, whereas in method 1 it's been more or less flat. So when we come to these things, I hadn't seen this till I read his report. I did not realize how big the drift was that was coming from all of this. Okay, so now let's go back to regular programming. We're gonna, the theme for the rest of the run of the show is each of the rest of the 3 of them will each give 5 minutes on whatever they think you absolutely have to know. Then we'll talk specifically about method 1 versus method 2 versus some other method if you want to make a recommendation. And then lastly, in a third go, any other technical fix-ups that you think are important that could be interacting with the earlier 2 panels, or just some technical fixes so that it's on the record and it's been recorded, and then we'll go to the audience. All right, so Wilson, the floor is yours.
Great, thanks, Anil. In line with the last panel, which gave us a little bit of history, because I'm of a certain age, I'm going to indulge in some history as well. What's the goal of this GSIB surcharge? How did we get here? Pre-GFC, there was no GSIB surcharge or large bank surcharge. The world was flat for capital. I guess our computers were simpler then, so we just did a simple ratio. So the more conceptual question for this panel is, why do we have this extra charge for GSIBs for large banks, and how should it work? There are actually 2 origin stories for how we got here today. One argument for GSIB was set out in a 2015 Fed paper that big banks need to have higher capital and therefore lower risk of failure because they do more damage in failure. Treasury Secretary Besson talked about a hazmat truck on the highway. That's clearly going to create more damage than a little Mazda Miata that skidded off on the side. So since the impact is bigger, we're going to want the big trucks to drive safer, and the Fed paper basically does a lot of math to equalize the expected amount of damage between a small bank failure and a big bank failure. Today, that surcharge requires about $230 billion of extra capital for the 8 U.S. lucky GSIBs, or about 3% in CET1 ratio terms. It's about a quarter of the total GSIB capital requirement here in the U.S. It's chunky, it's important, but it's only a part of a more complicated and evolving CET1 story, so we'll get into more of that a little later. There's also a second argument for GSIB surcharge, which is really separate logic. Back in about 2010, there was a senior regulator meeting over in Europe where a bunch of us big banks were told there was a temporary GSIB surcharge coming because we didn't have a too big to fail solution yet, we didn't have it funded, and until we got that, we're going to need some surcharge to reduce the risk of getting to that promised land. So the rationale for this one was centered on the too big to fail problem, which was still very confused at that time. These two frameworks never really got reconciled. The GSIB capital uplift to equity did not include any benefit for when we figured out a smoother resolution path and vice versa. So over the last dozen years, we've actually added our own form of GSIB capital in something called TLAC. Being a GSIB means you need to issue TLAC to fund your own resolution, which is a huge change compared to the drama of 2008. I was unlucky enough to sit next to Tim Geithner on Lehman weekend, and he was frankly in a lousy place. He had a $600 billion problem, and he didn't have any ammo to deal with that. His least bad option was to invite a whole bunch of banks, probably about this number of people, down to the New York Fed for some kind of lousy sandwiches and stuff, and spend the whole weekend trying to borrow capital from those banks to fund a bad bank, and then get an M&A takeout for the good bank. That didn't work. It had a lot of dance steps, and it's lousy to be in that kind of situation, to have a big bank failure in your hands, but no ammo to work with. But the resolutions that we've been designing over the last decade don't require a consortium, don't require a weekend, don't require an M&A takeout, but instead tries to self-fund resolution via TLAC debt. And TLAC today isn't a small number. It's $1.1 trillion in the United States. That's 4 times bigger than all the TARP funding that went to the big banks and got them back on their feet. And to me, this is actually the most important sleeve of GSIB capital. And that should help us mitigate to some extent some of the upward drift that you saw in that previous slide from Anil. I'd like to mention 2 other points for the big picture section. First, the real answer for GSIB equity capital buffer doesn't turn on a single component. We have a lot of components that build up into this thing. Investors and creditors care about the whole capital stack, and we have a lot of reforms in place, and figuring out exactly where that dial gets set is going to be where the rubber meets the road. If we turn all of them to the left or the right, I don't think we're going to have a very good meal. I think we'll over or undercook it. So getting that balance right and getting to a decent total number, I think, is the critical part. In the 2023 regional bank crisis, it was really, really helpful that the US GSIBs were perceived as rock solid. That crisis kind of faded from memory pretty quickly. You don't hear people talking about it very much now. And it was a much different episode than we had when the system went from small banks to medium-sized banks and to large banks in 2008. So while I think that we can do some tailoring around how steep the GSIB surcharges get, I do think that we want to be careful not to experiment with that achievement too much, because we've achieved a lot in the US by making the core of our system so much safer. 2023 raises one more point. The regional bank crisis exposed a soft spot in the middle of the US bank landscape. First Republic and SVB were $200 billion banks that fell apart quickly and cost the FDIC and then a bunch of other banks in this room a lot of money as they got charged back for those payments, and caused a lot of stress around the system. SVB even required a systemic risk exemption, which is quite an accomplishment for a bank that is so far away from being a GSIB. There are 8 or 9 non-GSIBs that are bigger than SVB today that don't have to carry either of the GSIB capital protections. Several of these are in the $500 billion range, which is coincidentally about the same size as Lehman or about the same size as Continental Illinois, the OG, too big to fail bank, if you scale it up for the size of the banking sector back then. These super regionals are clearly better run because they survived both the GFC in 2023, but unfortunately, good management is not a permanent, immutable attribute. So I'd argue that we have a too middle to fail issue that remains still unaddressed today, and I hope we don't have to wait for a second 2023 to learn that lesson. I wouldn't want to be stuck in Tim Geithner's rough weekend of dealing with a very large non-GSIB failure without any extra capital. So if I was going to sum all that up, I think GSIB surcharges, some of this buffer, should start a little bit earlier in the system, but we can also flatten out how it affects some of the very largest banks, and I think that would give us a good balance of the overall result. Thank you.
Al, you're next.
Great. Well, thank you. So yeah, this is a topic that's well in the weeds and well into footnotes, so we'll deal with all that part later. So I think I'm going to uptick Wilson's comment about 230. So flipping over at 4Q24, the 230 had ticked up to $250 billion. So yeah, it's a big number of capital, and really the question is this the right number, and how do we arrive at that, and is that the right distribution? Just in terms of the sort of GSIB points measurement, so which is roughly linearly aligned to the surcharge itself. So since the first year in 4Q15, that's up about 22%. Just for some comparatives, if I flip over to GDP, real GDP since then is up 24%, and so nominal GDP is up 62%. So pick your measure, but certainly the system has grown, and the largest banks have been required to hold a bit more. And before we get much further into this, I think it's really important to say that really what we're talking about is high versus very high levels of capital, and not low versus high. And I think it's an important effect. So I think that and just this week is a pretty unique one because this past Sunday was actually the 10-year anniversary of that Fed Method 2 white paper. So I encourage you to go ahead and read it. Not by me. But I think, and sort of since that framework was adopted, just remind everybody that all banks grew and not just the GSIBs, right? The surcharges are only applicable to the GSIBs, but all banks grew. The 8 U.S. GSIBs grew since then, or really for a comparative basis, just in 4Q17, the 8 GSIBs are up about 19% in score points. Admittedly, JP Morgan's up 39. The Cat 3 banks, when you think about what is the GSIB surcharge, that sort of differentiates the required capital at GSIBs versus the non-GSIBs. But the Cat 3 banks were up, meaningfully and kind of closer and well north of the GSIB overall size. So the incentives set forth in regulation do work. So I'm going to come back to this throughout the session, but I just want to make those couple of points for sort of two big reasons. So one is that the GSIB itself is a relative measure that drives additional capital between GSIBs and non-GSIBs. And two is that all banks have grown significantly in this measure. And that means the Fed should do a fundamental relook at the calibration rather than a simple rinse and repeat of the 2015 calibration. So let me just go to my first, my direct sort of main 3 points here. So one, fixes are needed. We must start with the policy goals and then perform the macro calibration and go from there. So the 2023 NPR and all of the subsequent Fed speeches just simply don't go far enough to address the issue. The policy goals, when we talk about what policy things we're trying to address here, so that should really include the appropriate trade-offs between economic growth and safety and soundness, both important and needs a proper balancing. Importantly, think about designing the shapes and contours of the activities that are contained within the banking perimeter. In having a step back and looking at how do we reduce the risk of bank runs and promoting financial stability. So all these are critical, and it's important for the public to understand how this banking, this complex banking regulation is really meant to protect the system, because the whole is greater than the sum of the parts. The second big point is that diversification should be valued and not penalized. And so having diverse business model and diverse set of income streams is a source of strength for all companies, whether financials or otherwise. The third is that the GSIB surcharge is really the final and additive factor in the capital stack. And so the calibration must, and I say must, reflect the totality of all regulations to ensure it's fit for purpose. If we look at everything and make sure the cost of low-risk activities are appropriately calibrated. So as we think about the current GSIB framework, and we should keep an open mind, there are two important lenses to apply. Is that the U.S. GSIB Method 2 does provides a gold-plated differential versus the non-U.S. GSIBs. And domestically, the GSIB surcharge is a capital differential between the Cat 1s and the Cat 2, 3s, and 4s, or the non-GSIBs. For the avoidance of doubt, we support tailoring. Tailoring is important. We recognize it's reasonable for the largest banks to be held to a higher standard. It goes back to my point earlier, right? This is high versus very high, and not should we have it at all, or is it high? But the challenge is really in defining that higher standard. So the U.S. GSIBs are already subject to the highest standards of resolution planning, recovery planning, TLAC, long-term debt, as well as the most stringent liquidity risk management practices and the highest levels of capital. The capital dimension is particularly key here, since the GSIBs are also subject to an even higher SCB through the global market shock and largest counterparty defaults. So later on, we'll nerd out on the Method 1 versus Method 2. In short, and speaking as a practitioner, the Fed did some smart things with the Method 2 that helps us better manage the risks when compared to the shortcomings of the Method 1 paradigm at Basel. One important issue identified by the Fed was the clear recognition of the structural headwind due to economic growth, the infamous footnote 25. Unfortunately, this has been left unaddressed, although a temporary solution was proposed in the final rules. But all this taken together, it takes us back to my first key point, is that the Fed needs to address the broader policy goal, and we could redesign and recalibrate the GSIB surcharge accordingly. This is critical to ultimately arriving at the right capital differentials that should exist between the GSIBs and the non-GSIBs here in the U.S., as well as the differentials between the U.S. and foreign GSIBs.
Well, first, Fed Vice Chair Bowman, members of the Fed, it's an honor to speak before all of you. Thank you for the opportunity to participate in the panel. Maybe just to set the stage, I do think we need to be clear about what we're trying to accomplish with the review of the GSIB framework. And from my perspective, the goal is really to address the shortcomings with the current GSIB framework and ensure that the largest banks can remain competitive on a global scale without compromising the safety and soundness of the overall system. So it begs the question, why hasn't the Method 2 framework worked as intended? What are some of the shortcomings that need to be remedied? So I'm going to list 5 here, and I'm sure others will have different ones that come up on their top 5 list. But first is GSIB surcharge and capital volatility. When Method 2 was first proposed, the intent was to avoid the pitfalls of Method 1, including volatility in global denominators. But as we showed in the chart earlier, history has proven that the GSIB surcharges have been more volatile under Method 2 and have also seen much greater inflation, which, as Aldous mentioned, is really more attributable to economic growth versus increases in systemic risk posed by the large banks. The second point is just that Method 2 is not an accurate gauge of GSIB riskiness based on some measures. Going back to 2016, when comparing GSIB score growth versus risk-weighted asset growth, GSIB scores have inflated 3 times faster than RWA. The third point boils down to U.S. bank competitiveness. Gold plating, imposing tougher capital standards, it does create an uneven playing field. It might be the proximity to Al here. I feel like I have Jamie Dimon in my ear saying we shouldn't get complacent. We have the deepest capital markets here in the United States. It's important to protect that advantage. Fourth point is about unintended consequences. Imposing higher capital requirements, it causes a pullback in lending, it limits credit availability, but especially to low-end consumers.